will be discussing.
There you go.
Hello, everyone. We will be discussing the implications of narrow versus broad accounting standards. I will be arguing in the affirmative. My name is Jason. Our affirmative argument: accounting standards in the United States provide too many reporting options and should be narrowed so as to allow fewer choices. Essentially, what we have in this debate is this dichotomy that has happened in the accounting profession for many years, this idea of rules-based standards and principles-based standards, whereas rules are smaller units that are more clearly defined, that have a little more measures of objectivity. But there's usually a lot of them, and the way they interact is very complicated, versus principles-based, where you have a broader set of concepts that are allow someone to extrapolate more things and better represent, sometimes arguably, the economic transactions underlying in the financial statements. I'll be arguing for rules-based. So rules offer us bright lines, clear guidance. They have a lot of usual benchmarkers. Something should be measured in this way. It has to meet a standard. The old leasing classification standard, or the new one, is a good example. It says it's not a lease, this type of lease, unless it's not owned by the principal. It's used for this purpose, right? It makes these types of things tend to make audit less daunting of a profession because it gives you clear guidelines, and it makes even a novice auditor able to say, this is probably that, right? Because you're giving such clear guidelines on what things are. And because you have clear guidelines, it allows for consistency in application of those guidelines across transactions, which means that if you're an auditor taking a sample, for example, it's a lot easier to compare your 5 sample transactions or to a field of hundreds and hundreds of them, because you have a standard way that these transactions should be structured. It makes standard setting easy for regulators because we have this body of work that we just need to break out into more specific rules. And Nelson and Shipper are two academics who noted in their works regarding principles and rule-based standards a set of advantages for rule-based standards. It allows improved communication for standard setters' intentions. So when the FASB or the SEC creates an accounting guideline, an accounting rule, we know exactly what they mean. We can hear from them. They are the ones that are dictating this. It is very easy for us, the governed public, to understand how we will be governed. It increases verifiability for auditors and regulators, and a related reduction in litigation. So it becomes a lot easier to say that this is legitimate because we have rules telling us what is good and what is bad, right? What it follows the rules and what doesn't. And principles, like the tendency with principles is that some of them could be diametrically opposed to one another, like relevance and reliability. And because of that, when you use a principles-based framework, you have to often choose between the two, whereas rule-based framework, you don't. Development costs, I think, were a good example. In IFRS, the example of a non-functional cure for cancer, for example, in IFRS, you could classify this work-in-progress asset as an asset, right? You clearly want to make this into like some type of patent, and IFRS says, well, it doesn't work, but you can make it a patent now. Because it's based on a principle versus a rule. In the US, in GAAP, we do not capitalize research and development costs. It is an expense. And it's a lot easier to say, at what point does this cancer, is it when it's useful? Is it when it works? Right, well, no, it's an expense until it's not. Second argument: it preserves the compatibility of financial statements. An increase in reporting options generally inversely correlates with the comparability of financial statements. If you have more choices to make and you give people more choices and more leeway, they're going to make differing choices, which makes it hard to compare these financial statements against each other, apples to apples. And if investors can't compare these financial statements, how do they know who they want to invest in, especially when companies are in a similar sector? What decisions are made, right? Relevance becomes a key argument for the proliferation of rules-based standards. And what are the incentives, right? Management has an incentive to make themselves look good, right? And investors obviously have an incentive to make money and make returns on them. There's a different advantage, there's a different incentive set, and investors are not going to magically say, I want to comply with all the rules unless they are forced to, right? They don't want to just magically instantly get at the underlying economic substance of all transactions. That's something they have to be told to do. And that is what our rules-based system allows for. This is a very good quote from, I'm butchering this, Pitinoy and Abdullahi. It can be concluded from their study that financial statement comparability can increase the transparency and comprehensibility of financial reports, reducing the manager's opportunistic behavior and the likelihood of fraudulent reporting. Clearly, it's giving us a framework for how compatibility is important and how rules-based systems proliferate it. Speaking of proliferation, our third point, it reduces the frequency and cost of litigation, and it proliferates the accounting profession. So when we have precise rules, it becomes easier for the reportees, the auditees, the firms to follow them. Makes sense. When we have precise rules, it's easier for auditors and the audit firms to tell clients, you are following these rules, or you are not following these rules. And the presence of these rules is important. Obviously, if we use principle-based or rules-based, we're going to have accountants, but the fact that there's a lot of rules means, we have to have CPAs, which keeps the profession alive. And all of us who are speaking today are accounting students and are biased in that. So I think we can all agree on we want to have jobs when we graduate. There's this idea of protection theory when it relates to legal costs, and that rules, the accounting rules-based accounting standards, provide safe harbor for firms and audit firms from frivolous lawsuits. Essentially, it provides, because the benchmarks are so clear, the bright lines, these rule-based standards are very specific and very clear. It prevents frivolous lawsuits against an audit firm or an auditee, especially when there's no grounds. It wastes a lot of people's time because the types of people that could sue potentially are not experienced users of financial statements. They're not private equity investors. They're not a manager of an audit firm or CEO of a company. They're just the layman, the investing public, the public, everyone. So they may not know what they determine to be reasonable grounds for suing someone is not the same as what you and I would consider. So it's important that safe harbor be considered in this argument. The innocent misstatement is a legal offense, which also allows for, because we have a lot of standards, and it's easy for someone to run afoul of them, it usually assumes that these companies are not at fault unless otherwise proven so. And furthermore, as a result of these two things, the funds that would otherwise be spent on frivolous lawsuits can now be spent, employing accountants, which is a good thing. And now that will bring us into our statement of our opposing argument.
All right, thank you, Jason. I am Cameron Tummino, and I'll be presenting the opposing argument. And Jason, I'll let you know when to go to the next slide.
Awesome.
So the discussion about how much flexibility reporting entities should have really boils down to the comparison, like Jason mentioned, of rules-based and principles-based accounting. The argument for more narrow and restrictive standards supports the idea that rules-based accounting is superior because it provides more reliable financial statements. Although I also believe this to be true, let me ask you this. If I'm looking for the best dog food to feed my pup, would perfectly reliable information about cat food help me at all? I argue that broader standards rooted in principles and reporting objectives are superior because they provide more relevant information to investors, creditors, and lenders, whom the FASB and the accounting community have deemed as the primary users of financial statements. According to a researcher from the University of Northern Iowa, accounting standards usually contain both rules-based and principles-based elements that determine their place along the continuum, which highlights the complexity of accounting standards and the pendulum that current US GAAP establishes between these two accounting ideals. Our argument is that the FASB and other accounting standard setters should focus on creating guidelines that allow management more flexibility and choices in financial reporting to enable the enhancement of relevance, provide agile adaptation to technological and market changes, and to enhance stakeholder understanding and confidence. Next slide. So the first main point of the opposing argument is that allowing managers more discretion for financial statement presentation will increase the relevance of those financial statements and will have a positive impact on their primary users. One case study from the Journal of Accounting, Auditing, and Finance aims to understand the extent to which financial reporting benefits from management having greater discretion for the treatment of research and development costs. The test conducted focus on comparing reported earnings that reflect the expensing of R&D costs currently established in ASC 730 and adjusted earnings and book values that mimic the effect of allowing management to choose whether to expense or capitalize. The results of the study indicate that the broadening of this standard, quote, has the potential for improvement of relevance to be much greater if managers are permitted to exercise substantial discretion, end quote. Because at the end of the day, management has the most information to determine whether these costs can be matched with revenues in future periods. Expensing costs now that generate revenue in the future violates the many sections of the codification that collectively make up the matching principle. Now, sure, telling all companies to expense now makes the financials more reliable, and I argue that this standard is okay for firms that don't have substantial spending under the R&D umbrella. But for companies operating in the technology, energy, and pharmaceutical industries, allowing management to classify these costs appropriately can provide much more relevant information to financial statement users and therefore enable better decision-making and competition. Increased flexibility reflects business complexity and uniqueness. And you can go to the next slide. The next point I'd like to bring up to support broader accounting standards is their ability to enable agile accounting. Now, as we all know, the world we live in today is extremely fast-paced, and accounting dilemmas such as new investment instruments, technological advancements, and unprecedented market and societal changes are more common now than ever. Unfortunately, the rigidness of US GAAP today makes it difficult for companies to accurately reflect novel accounting issues. However, there are a few standards that are rooted in financial reporting objectives, which require managerial judgment for appropriate reporting. For example, ASC 606 about revenue recognition allows managers to exercise judgments about transaction prices, including the initial allocation and especially when variable consideration is involved, and whether revenue should be recognized at once or over time. Additionally, ASC 360 about the impairment of assets allows management to determine when an asset may be impaired, impairment testing procedures, and the estimation of the amount that is recoverable. This requires judgment in forecasting future cash flows and also selecting an appropriate discount rate. ASC 820 about fair value measurement also requires substantial managerial discretion, especially for assets in the level 3 category. Now, these three sections of the FASB codification are amongst the broadest and allow managers the ability to determine the proper treatment that is most representative of what is really going on. Now, it is worth mentioning that these topics are largely focused on by auditors, which ensure that the decisions made by management are truly in accordance with the principles of US GAAP. But the main point here is that these standards can easily be adapted to emerging issues and allow companies to reflect changes more quickly in their changing and evolving environments. Next slide. And this brings us to the final point of the opposing viewpoint, which focuses on the benefits of broader standards on stakeholder understanding. Now, by doing so, revising other ASC sections to align with the principle-based nature of these standards was looked at closely in a case study conducted by a University of Northern Iowa researcher, Jody Faring. And in her analysis, Faring looked at APB number 18 regarding the use of the equity method for recording investments in common stock and considered the implications on stakeholder understanding if the standard was modified to be more principles-based by removing the 20 to 50% rule when determining significant influence. Instead, companies would exercise judgment when determining whether to use the equity method over the cost or consolidation methods. She stated that, quote, the 20% to 50% guidelines would not be available as a crutch to make fast and easy decisions, and that, quote, management would be forced to consider its ability to influence the investee to determine the proper accounting treatment. Now, the assumption that a company's ability to exercise influence is determined by a percentage of stock does not accurately reflect the dynamic nature of businesses today. Although the stock holding percentage is an indicator and a good one of a company's ability to influence another, this is not always the case. A broader objective and principle-based rule would theoretically result in a more accurate recording method selection based on numerous factors instead of just the bright line 20 to 50% rule. Therefore, stakeholder understanding of the investment would be better determined and trusted. This conceptual dilemma exists with several important sections of the FASB codification, and oftentimes rules don't really capture the actual implications of the item being reported. Although this makes financial statements a bit more comparative, shouldn't we place more importance on presenting the financial statements accurately and fairly relative, keyword relative, to what is going on at the business? So, in short, broadening accounting standards to provide management with more discretion will increase relevance, empower companies to respond to emerging issues effectively and consistently, and will increase and enhance stakeholder understanding and confidence. Do we really think that perfectly reliable information about cat food will aid decision makers with their purchases of dog food? Thank you. And
All right.
next is the
Uh,
rebuttal.
th- yeah, thank you, Cameron. That was great. Right. So, in terms of the rebuttal, Jason definitely mentioned some excellent points regarding, the affirmative viewpoint. However, I do have some rebuttals, that might, expose some deficiencies that should be addressed. Next slide, please. Right. So moving on to the rebuttals, I had regarding the affirming argument, I would like to begin discussing the reduced complexity towards reporters and users. It could be agreed that reduced complexity and increased structure within the accounting profession may prove helpful to the capital markets. However, this reduced complexity may come at the cost of exploiting rules-based loopholes. Given the current sentiment by FASB reinforcing the notion that strict rules-based accounting principles provide a variety of benefits towards the investor, whom of which is mainly the clientele of which we serve, it would be logical to assume that the stricter the rules are, the less room of opportunity companies have to inflate their earnings. However, during my research, I found various sources showing empirical evidence stating otherwise. Under the current mindset surrounding FASB regulation, there means a show me where I can't attitude associated with strict accounting standards or rules-based standards. In other words, the current attitude reflects a mindset of where in the rules does it say I cannot do this or that, which is a very literal interpretation of regulations. Therefore, it can be argued that there is greater room of interpretation when given strict rules, allowing for further exploitation of loopholes. As companies discover more and more loopholes, FASB must maneuver quickly to stop exploitations, which may narrow management discretion to a high degree, consequently hindering capital markets. Now, relaying back to the empirical evidence mentioned, Agoglia, conducted an experiment regarding the treatment of lease capitalizations under rule and principle-based accounting rules. Under the current SFAS 13 regulations, which is a rules-based accounting method regarding lease capitalizations, two groups of financial statement preparer participants were notified of a bright line threshold regarding lease capitalizations and a more broad major term of expected life criterion. In other words, one group was given a 75% threshold where a lease term must be 75% of an economic life. That was given to one group, and another group was given a more vague term where it's just a major term of expected life. The experiment conducted found that 61% of participants aggressively reported their findings under the strict rules-based method, while 15% aggressively reported under principle-based. This reflects a more conservative professional judgment regarding vague rules. The results of the experiment are very interesting, as it seems that with further tightening of rules, the ability for companies structuring their leases to keep them off the balance sheet is reinforced. It seems that companies under strict rules and reduced complexity may have the added benefit of circumventing the intentions of regulations. However, there remains the question as to the principle-based group. Next slide, please. So why are principle-bound financial statement preparers more conservative? Well, that moves me on to my second point here, where the comparability of financial statements remains intact, arguably even more comparable. As mentioned before, there is a FASB notion that increased regulation increases comparability. However, results from the experiment mentioned previously, along with the work conducted by Nelson in his research, can show otherwise. Management under current conditions are automatically assumed to undertake aggressive interpretations of vague, principle-based accounting rules. However, this does not seem to be the case. Nelson argues that there is a psychological role that plays into the interpretation of rules. Management becomes more concerned with the negative implications associated with breaking compliance. Why? Well, because management is no longer has well, it doesn't say that in the rules mindset. There is a fear of consequence associated with greater discretion over the possibility of failing to comply with accounting regulations. As the study states, the uncertainty surrounding the risk of being received to be out of compliance is inherently greater without detailed guidance. Keeping this in mind, if management is placed under reduced thresholds, bright lines, and rules-based accounting, then so are the auditors. Now, this is a key point regarding the rebuttal. Auditors are given greater discretion over aggressive management decisions. Without management falling back onto the interpretation of very specific rules and guidelines, auditors are more able to adjust and oppose certain management decisions, allowing for more representative financial statement values. Any material attempts to engineer accounts could be thwarted by the greater auditor power. Given that auditors are impartial and unbiased in nature, hopefully, the additional element of discretion towards auditors allows for more accurate financial statements. Professional judgment of the auditor and influence over the makeup of the financial statements are enhanced, hence greater use for the investor, allowing for more educated capital allocation decisions. And next slide, please. Now this relates to the one study that I mentioned before. So if you look at the weak and strong columns, this represents the audit committee strength, but in terms of the rebuttal, it's not entirely relevant. However, I do want to focus on the standard precision. So less precise includes the vagueness of the majority of the economic term. More precise is the 75% bright line. Now, what I want to look at is the variability and the comparability between the financial statements. So if you look at the weak column and you look at less precise, within the parentheses, you see 2.24. And under more precise, you see 3.08. This represents the standard deviation between the different financial statements issued by those the test subjects. So as you can see, there seems to be less variability between the final least number calculated with the less precise, I guess, limitation and the more precise 75%. 75% has a standard deviation of 3.08, which just shows a little bit more of a variability between financial statements, which coincides with my last point. Next slide, please. Lastly, I would like to discuss the fear of non-compliance when management is given greater discretion over their accounting decisions. Fear of outside litigation from misrepresented financial statements acts as a major deterrent within both rules and principle-based accounting methods. However, although theoretically the increase of rules may circumvent these risks by allowing a sort of brick road to be laid, as Jason meant, where if you stick with the rules, you can't really go wrong. I argue that litigation could also be reduced via principles accounting as, acting as a pure deterrent. As mentioned previously, companies have the ability to argue for their decisions if the accounting rules are circumvented through structuring, i.e. restructuring their lease capitalizations. Restructuring removes the liability from the balance sheet, hence, improving ratios. So how could these earnings management techniques, still be averted even if management has more discretion? I simply say, as studies such as Agovia's study suggests, that less precise the standard, the more concerned preparers are about second guessing and possible costs imposed through litigation. Management have incentives to honestly and accurately report their underlying economic transactions in order to defend themselves from external party inquiries, such as questions from the SEC or FASB or other regulatory institutions. Therefore, although there is no explicit diversion from potential litigation costs, the implicit influence posed by greater discretion may divert litigation costs altogether. Overall, greater discretion to management may surprise the investor. Definitely surprised me when I did my research. Between the reduction of loopholes, reduced variability between financial statements through increased auditor discretion, and well, overall increased fear of litigation, keeping management techniques in check, the investors may allocate their capital with greater confidence. Next slide. And that's all for me. I'll pass it on to Eli.
Okay, thank you. I'm Ellie. I'll be directing the rebuttal against the opposition. So I want to start with relating this to Enron, the accounting scandal that happened around 25 years ago. The mistakes that caused that massive scandal could be seen with the managers playing with the rules. They were able to go around the faulty internal controls, going through loopholes in the accounting rulebook to make sure their company looks better than what it actually is. And it all came crashing down due to managers having more options than what is in the rulebook right now. So, the SEC wrote an article after SOX was released about principle-based accounting, and it said some of the concerns that have been expressed about principle-based standards include: one, a loss of comparability because of management and auditor discretion and the application of the principles; two, a greater difficulty in seeking remedies against bad actors either through enforcement or litigation; and three, a concern by preparers and auditors that regulatory agencies might not accept good faith judgments. This further exemplifies the concerns that will happen if principle-based accounting or allowing more relevance or more manager discretion in the financial statements. So moving on to the next slide. So the first point of the opposition was that increased manager discretion will increase the relevance of the financial information. So if you allow managers more discretion, the risk of manager bias increases. This can include an increase in earnings management or an increase in information asymmetry. So for the financial statements, they're supposed to decrease the information asymmetry between the investor and the manager. But if you give the manager more opportunity to play with the numbers, they will have more an advantage with the information that they have compared to the investor. So now going back to earnings management, the risk of earning management increases because of the flexibility it gives to managers. In regards to what was stated by Chambers, in that same article, he writes that the results of principle-based accounting should be taken with caution because they're an indicator of managers' expectations regarding the future benefits likely to result from the current and past R&D expenditures. So this was talking in relation to the research and development, whether to capitalize it or to expense it. So if these assumptions that the R&D is going to provide future economic benefit, they have to be right. And if they're not right, that means we're overstating our financial statements. And I like to relate this to gain contingencies, loss contingencies. We don't recognize gain contingencies until they are actually earned or actually gained, because we don't want managers to overinflate their balance sheet or income statement. So too with R&D expense, we shouldn't give managers the discretion to capitalize R&D because it may not actually happen. And then the last point in regards to the first point of the opposition, the one-size-fits-all approach, even though it may not seem that it's ideal, it is the most ideal for the investor because it allows the investors to compare one entity to another and allows them to allocate their resources in a meaningful way because they are able to compare each company to each other. Now on to the next slide. The second point, which is broadening the standards, will enable agile accounting. Even though the world is ever changing, accounting standards cannot move as quick as a world due to the process of creating these new standards and making sure that they don't have any loopholes. They need to be carefully reviewed to make sure that it fits the framework of financial accounting. Yeah, they just need to make sure that they fit the framework of accounting and no loopholes can be found through these new standards. Also, the constant change of accounting rules will confuse companies as well as the investors themselves, and this will ultimately undermine the effectiveness of financial reporting. Now talking about the ASC 606, which is about revenue recognition. In ASC 606 102534, it gives us the knowledge of how to measure the progress of recognizing revenue. And this may seem like the managers have discretion in recognizing revenue, but they still have to abide by certain rules in order to recognize the revenue. And now going to ASC 820, which is about fair value and the fair value hierarchy. So managers have the ability to decide what the fair value is if there is no principal market or observable inputs. This is called level 3. But this is very faulty because these are just estimates. Even if they're good estimates, they could still be wrong, and we want to avoid that as much as possible because they can jeopardize the reliability of the financial statements due to a lack of definitive knowledge. So in a research paper written by Riedel and Serafim, hopefully I didn't botch that, they conclude that firms that use level 3 data are at a higher risk of information risk. So we want to avoid using level 3 as much as possible to give the investors the best information that we can, the most reliable information. Now, the next slide, please. The final point that the opposition made was that broader standards increase stakeholder understanding of the financial statements. So in regards to the study made by Faring, at the end of the article, she writes that I do not believe the potential benefits of principles-based accounting standards outweigh the extra resources necessary to ensure the use of accurate judgment. Even she does not believe that the implementation of principle-based accounting is worth it. Now going to the equity method control 20 to 50% bright line. So the 20 to 50% rule may not be perfect, but it is rigid and it makes things clear for the investor and provides consistency for financial reporting because it outlines what is the percentage of stock ownership and what methods are we going to apply. So if we go on a case-by-case basis, it can introduce us to inconsistencies and lessens the understanding of stakeholders for what the balance sheet and the income statement will have. Because if we're going by case, inconsistencies lead to unreliability and more confusion overall. So now going to the cloud computing agreement that came about in 2018, there's accounting standards released that would standardize the entire process, and then this would eliminate the manager discretion and eliminate the diversity in practice. And Goldstein writes from the Journal of Accountancy that the standard eliminates some diversity in practice, and the 20 to 50% rule for showing control is there to make financial statements consistent, as that is one of FASB's goals. And to conclude, by allowing a broader accounting standards to benefit management, it will underscore the importance of the investor and lead to confusion on their part. The financial statement should be focused on providing reliable information rather than providing relevant information that could even be wrong. And I'll like to pass it to Cameron to end off the affirmative argument.
Well,
oh, my bad. Pass it to
no,
Jason.
good.
My bad.
Oh, it's okay. So, as for our closing argument, so narrower standards, we like them. Let's talk about why. So, in review, narrower standards, rules-based standards, they're clearly defined and they help all parties involved. Someone who's preparing financial statements says, oh, I know that the equity method exists between 20 and 50%. I have a clear guideline to work with when I'm reporting this information. A user can better compare firms against each other to make clear decisions on how to allocate capital because all of the statements are comparable. And the regulators can create a stringent environment that reduces overall violations and resulting litigation because they have all these things. We have these rules, they're very clear. If you violate them, you're in trouble. And at a fundamental level, the objective of financial accounting, is we want to impart knowledge to the users of financial statements, the various parties, right? And we recognize we can't get all of them. But we also recognize that knowledge is fundamentally useless if the principles are too vague and everyone can just choose their own favorite accounting treatment to do whatever they want. We can't compare. How are we going to have an equity market if nothing can be compared? So I will now pass it off to Cameron to close out our opposing side.
Thanks, Jason. So Eli made some good points, but I'm going to present now the closing argument that hopefully answers some lingering questions. So at this point, we have laid out the reasons for supporting the viewpoint that broader reporting standards will be beneficial to financial accounting and reporting. As we mentioned in the opening argument, our debate boils down to a comparison between rules-based and principle-based accounting. Based on our research, narrow accounting standards are more rule-based in nature and allow little to no flexibility for management to exercise judgment and discretion when preparing the financial statements. So I ask you this, does the FASB know exactly how my business works? Do they know every difference between every industry and operating model? By posing these questions, we are not critiquing accounting standard setters, as our argument has a basis that a universal accounting standards guide is imperative to the US economy and competition. But by asking these questions, we are demonstrating that financial statements cannot be narrowed down to specific rules for management to follow blindly. This argument is also not pro-management. In fact, broader accounting standards would make management's job more difficult. They would be forced to exercise more critical thinking and immerse deeper into the inner workings of their companies to determine the true economic events and transactions that are happening. This would in turn increase the effectiveness of management. Broader accounting standards would also require more labor and capital to effectively implement for managers and auditors. But in our argument, we would like to suggest that standard setters and lawmakers consider implementing protections against corruption. Allowing managers to exercise more discretion over financial reporting comes with a risk of increased motivations that are not directly tied to the external stakeholders. The limiting of incentives for managers would be an effective way to minimize these risks. Our argument and associated research aim to increase the relevance and overall benefit of financial reporting on its primary users, who represent the main parties that the financial statements are created for. And you can go to the next slide, Jason. Our opening argument and rebuttal present valid and research-backed arguments against a shift towards narrow reporting standards. We argued that broader standards have the potential to increase the relevance of financial statements via increased manager discretion, in our example, allowing management to choose whether to expense or capitalize their costs in these categories. We also talked about how broader standards would allow more agile accounting and decrease pressures on the FASB and financial statement preparers when new accounting issues present themselves. Eliminating the, quote, crutch to make fast and easy decisions, according to researcher Jody Faring, can increase the overall quality and relevance of financial information. Our rebuttal discussed how strict standards could allow for easier loopholes and, on the topic of leases, facilitate managers to tweak contracts to facilitate more attractive financial statements. Broader standards would mitigate this tendency by increasing focus on economic substance of leases rather than the minor details. Our rebuttal also talked about how more narrow standards would have a disproportionate impact on small versus large companies. To close our argument, a one-size-fits-all accounting rulebook is not sufficient for capturing the uniqueness of different business models and industries. Forcing all businesses into a cookie-cutter mold can misrepresent important details and decrease the relevance of financial statements. Wouldn't you agree? And that's it. That's our debate. And on the next couple of slides, we have the sources that we used.
All right, thank you.
Thank you, everyone.